The Rebel Capitalist Show.
How do we reverse everything the Fed has done? So they've taken their balance sheet to 800 billion prior to 2008, goes up to 4 billion, let's say. Now it's up north of 7 billion. And let's just be realistic. If they're going to do this yield curve control like you're talking about and pegging the curve, I mean, the balance sheet of the Fed's going to go 10 trillion, 15 trillion. What if they start buying equities? I mean, where does it end? So number one, how would they unwind that? And is that even possible for them to unwind? And if it's not possible, then what does that mean for the dollar? What does that mean for inflation, gold, Bitcoin?
So this is why I own Bitcoin. So, going back to somebody that I really admire from an investing standpoint, Ray Dalio. So Ray talks about there's 4 paths that a central bank can take when they get in this situation where interest rates are at 0%, there's no peg. We're completely dealing with fiat currency and interest rates are at 0% and pretty much across the whole duration. They have to start doing quantitative easing. And this is nothing new. This has been done throughout time and time again. Read the book, This Time is Different. We were talking about Bill Gross. This is one of Bill Gross's favorite books. That book probably provides 50 different examples throughout history of this happening time and time again, right? So when you get to 0% interest rates, your money has no peg. You have to start printing. You have to start supplying that liquidity into the system. And you pretty much have 2 paths to supply that liquidity into the system. You can do it straight into the financial markets by bidding financial asset prices, which is what we've done for 10 years. The other path is to put it straight into the hands of the people that call it helicopter money. Today, they're calling it universal basic income. Whatever you want to call it, it doesn't matter. It's the same exact thing as QE. The only difference is on the one side, you're bidding the assets. The other side, you're just putting in the hands into the people of the economy, the U.S. citizens, right? Both of those scenarios lead to disaster. And so Ray Dalio's point is when you get to a situation like this in an economy where there was manipulation to begin with, which caused the polarization of the game, like we didn't allow failure to occur. So that's how you get in these situations. Too much manipulation gets you in these situations. So now you have 4 outcomes that can actually solve the problem. The solutions I've talked about are the solutions that they always default to. Central banks always default to those because they somehow think that that's going to actually solve it, but it doesn't. It actually makes it worse. You have to either go, and this is Ray's point, you have to do austerity, or you have to do debt defaults, or you have to print more money, which is the one I talked about, or you have to redistribute the debt. And so at the end of this, the only way you can really kind of get to the ones that are going to reset the system is you have to have a currency reset. You have to have a new currency that emerges as the desirable currency. And so when I'm looking at this situation globally, there's no sound money anywhere. It's not like you're going to go to China and they've got sound money, or you're going to go over to the euro and they have sound money. Nobody has sound money. And so that's where this is such a unique scenario is globally, there's no sound money. But when you look at something, for me, when you look at something like Bitcoin, or a lot of people like to say gold, that has a fixed supply, that's going to be the thing that ultimately resets it. And one of the reasons I like Bitcoin so much is because I'm not convinced that gold will actually solve the problem. The reason I don't, and this is a very controversial opinion that I have that I don't think very many people have, the reason I don't think gold will solve the problem is because gold didn't solve the problem from 1944 to 1971. Whether people want to believe this or not, we had an inflationary monetary policy from 1944 up to 1971. The reason we had an inflationary monetary policy, even though we were on a gold standard, is because you still had a trusted agent in the loop that was adjusting the money multiplier, which was a thing that just disappears after you don't have sound money or quote unquote sound money anymore. But they were able to exercise an inflationary monetary policy by adjusting this money multiplier. They were able to increase the money supply by just saying, well, You used to be able to come to the bank and give me $1 for an ounce of gold. Well, then it became $4 for 1 ounce of gold. Then it became $20 for 1 ounce of gold. And so as you're adjusting that money multiplier, what happens is you're actually debasing the money. You're actually implementing an inflationary monetary policy because there's a human in the loop looking at the ledger of gold sitting in the bank account or sitting in the vault versus how much currency and fiat money is in circulation. If you're adjusting that ratio, you're still having an inflationary monetary policy. The peg is in by name only, okay? Right. Where I think this is the first time in history we're in a situation where we might actually have sound money globally that can't be debased because there's no human in the loop. And what I also think is fascinating about this time and this massive big debt cycle that we're in that Ray Dalio talks about endlessly. Yeah. If anyone wants to see it graphically, just pull up the 10-year treasury and look at it from 1940 till now, and you'll see this perfect, mountain-shaped curve of yield where you saw it hit 16% in 1981, and it's come straight down. And from 1940s up until 1981, it went straight up, and then it went straight back down. So you can graphically see this long-term debt cycle and how we're at the end of it. And where I think going back to the Bitcoin piece, and Jeff Booth talks about, well, what's the implications? What happens when we have an inflationary monetary policy for 8 decades? Because that's what I think we've had. It is literally since 8 decades we've had an inflationary monetary policy. I think what it does is it creates this massive incentive structure for capital investment, for technological advancement. And Jeff Booth's argument is we're now moving so quickly that the only thing that can slow this down, with technology outstripping humanity's ability to keep pace with it, is to have a deflationary monetary policy. And I think the only way you could possibly have that is with Bitcoin. That's the only technology that I see that could supply it. I don't think going back on a gold standard is going to supply a deflationary monetary policy. I think if we went back on, let's just assume all these governments can somehow get along. Okay, yeah, big assumption, right. Real big assumption. Let's assume that they can all of a sudden get along, and we stand up a new global monetary standard off of a gold standard. They're going to go straight back to an inflationary monetary policy by the debasement of that, right, based off of like what I described earlier from 1940s to 1971. They're going to do the exact same thing, which means we still have an inflationary monetary policy. We still have the incentive structure for technology to keep trucking at a breakneck pace, outstripping humanity's ability to even handle it. So it's an exciting but concerning, because it has massive implications that if Bitcoin would stand up as a global currency, what it would do to the debt market is somewhat unfathomable, to be quite honest with you.
Yeah, right.
It's unfathomable, because at that point, anybody who's issued debt, they're not getting what they're getting back in return is a total pittance. I mean, it's a total impairment for anybody that's issued
it's debt. Almost like you do like a debt jubilee, because the central banks own so much of the debt that they just kind of forgive it and transfer to a whole new monetary system that people might have more confidence in, because that debt jubilee would probably ruin the confidence in the whatever was, whether it's dollars or reserve currency or anything like that. So that makes a lot of sense. Go ahead, Preston. I'm sorry.
So think of it like this. For just anybody off the street, let's say they just went and bought a house for $300,000 and they pretty much financed the whole thing. That contract is denominated in fiat dollars.
Right.
They are going to pay, like in the contract they signed with that bank is an agreement that I will pay you back in fiat dollars. If we move to a new currency that is much more desirable, and it gets realized, like that debasement that we all know is happening gets realized through the pricing relative to this other currency, the person who borrowed that money is going to be happy to pay that back, right? They're going to be real happy to pay that back, because all they're doing is they're holding that new currency, and the one that they're making the payments for, that contract that's denominated in fiat, it's getting debased at 20%, whatever percent a year, and they're paying 2% to interest on it, right? So they're netting 18% annually, if those would be the numbers, right? And so I don't think very many people in the world are thinking about what that impact would be. And so when we go and we look at Ray Dalio's 4 things that reset the economy, redistribution of debt defaults are 2 of those components. Bitcoin supplies that in a major, massive, unprecedented way on a global scale. So if you're somebody who's issuing debt right now at 3%, 2% interest in fiat, and the contract says you're going to get paid back in fiat, boy, oh boy, you better be ready for it, because it's not going to be a fun experience.